dear students. Welcome to the 9th session on the chapter Retirement of a Partner. So let us take up one more question here. On 31st March 2015, the balance sheet of A, B and C sharing profits and losses in the proportion to their capital stood as follows. On the asset side, we find land and buildings 2 lakh, machinery 3 lakh, stock 1 lakh, debtors 1 lakh, cash at bank 1 lakh. On the liability side, creditors 1 lakh, capitals of 3 partners 2 lakh, 3 lakh and 2 lakh. On that date, A desired to retire from the firm and the remaining partners decide to continue the business. The retirement was agreed on the following. The first one, land and buildings to be appreciated by 30%, machinery to be depreciated by 20%, stock to be valued at 75,000, RBD to be made, or we have to provide the provision for RBD or reserve for bad debt to the extent of 5%. The creditors of rupees 20,000 to be written back, joint life policy surrendered for rupees 80,000, goodwill of the entire firm to be valued at 1,40,000. The total capital of the firm is to be the same as before retirement. The capitals of B and C should be in their profit sharing ratio, which is equal. The amount to A is to be settled 50% on retirement and the balance within 1 year. Prepare revaluation account, partners capital account, bank account and balance sheet of B and C. So here in this question, we have some 2-3 extra adjustments. So as you see here in the 7th one, they have given the goodwill adjustment, which means that in the working note, we have to first calculate what is the gain ratio and then we have to show the adjustment of goodwill. So here it is given that the old profit sharing ratio was in accordance with their capitals. Okay, so here you can see the capitals. It is 2 lakh, 3 lakh and 2 lakh, which means that the old profit sharing ratio was 2:3:2 among A, B and C. Now who is retiring? A is retiring. Okay, we cannot take new profit sharing ratio as the gain ratio by applying case 2, because here in the 9th adjustment, in the 8th adjustment, it is given that the total capital of the firm is to be the same as before. The capitals of B and C, that is the remaining partners, should be in their profit sharing ratio, which is equal. So remaining partners in the future, they are going to share the profits and losses in the equal ratio, that is 1:1. So they have given the new profit sharing ratio. In this case, the old profit sharing ratio is given and even new profit sharing ratio is given. So we have to calculate the gain ratio by applying case 5. So first we need to calculate here what is the share gained by each of the remaining partner. Share gained is equal to new share minus old share, and then the share gained should be considered for calculating the ratio. Let's see how to calculate that. Calculation of gain ratio as per case 5. Share gained is equal to new share minus old share. So share gained by first partner, so it is 1/2 minus 3/7. When you simplify, you get 1/14. Then share gained by another partner C is 1/2 minus 2/7, which comes to 3/14. If you see, the denominators are equal, so the gain ratio comes to 1:3. Okay, so now in this 1:3 ratio, we have to make the goodwill adjustment. The total goodwill of the firm is valued at how much? 1,40,000, but we have to show only retiring partner share, that is 2/7. Okay, so let's also show the second working note with regard to goodwill adjustment. Total goodwill is 1,40,000. A share of goodwill is 1,40,000 into 2/7, which comes to 40,000, and this should be distributed between B and C in the gain ratio of 1:3. So B will have to bear 10,000 as a compensation and C will have to bear 30,000. So B's capital account data 10,000, C's capital account data 30,000, to A's capital account 40,000. Okay, this is distributed in 1:3 ratio, which is the gain ratio. Okay, so these are relating to the working notes. Then coming to the other ledger accounts, we have to prepare here which account? Revaluation account. So let's consider the adjustment with regard to revaluation. First adjustment given as land and buildings to be appreciated by 30%. Okay, we have to calculate 30% on 2 lakh rupees. There is increase in the value of land and building. We have to credit that to the revaluation account. Then machinery to be depreciated by 20%. We have to decrease the value of machinery. We have to calculate 20% on 3 lakh, which comes to 60,000, this should be debited to the revaluation account. Stock to be valued at 75,000. Earlier the value of book value of the stock was 1 lakh. Now it is decreased by 25,000. Again it is a revaluation loss. We have to debit that to the revaluation account, and we have to create RBD to the extent of 5% on data. So 1 lakh into 5%, which is a revaluation loss. Then the creditors of rupees 20,000 to be written back. If you check the liability side, the total amount of creditors was 1 lakh. So out of which 20,000 to be written back, which means that the company or the firm need not pay 20,000. They can save it, which is the revaluation profit. So it should be credited to the revaluation account. Then joint life policy surrendered for rupees 8,000. Okay. So here you have this concept in the fourth chapter with regard to this joint life policy. Joint life policy in the sense, on the joint lives of all the partners together, they have taken up one insurance policy, and that is surrendered now at the time of A's retirement for rupees 80,000. But if you check the asset side, joint life policy is an asset. But have they shown on the asset side this joint life policy so far? No. So there will be two adjustments. The first adjustment is that till now joint life policy has not been shown in the books as a asset. So you have to bring into record the joint life policy. It is as good as you are bringing into record one more asset. So it should be written in the revaluation account on the credit side. Then again the second adjustment will be for realizing that joint life policy, that is the surrendered amount you are realizing at the time of retirement. Okay, so these are the two adjustments with regard to joint life policy. So when you prepare the revaluation account, you have to credit that to the revaluation account, because you are bringing into record one more new asset. So only these are the transaction with regard to revaluation of assets and liabilities. So let us now prepare the revaluation account. So in the revaluation account, for decreasing the value of machinery, we have to write on the debit side, for decreasing the value of stock, and then for creating the RBD. Then coming to the credit side, for appreciation in the value of land and building, for writing back 20,000 from the creditor, which is a revaluation profit, and for bringing into record one more new asset, joint life policy. After this we are going to close the revaluation account. So we get the total of credit side more. So same total is written here. We get the balancing figure of 70,000 in the debit side, which represent profit, okay, net profit. So and this should be transferred to all partners capital account in their old profit sharing ratio. So A will get 20,000, B will get 30,000, and C will get 20,000. So this is regarding the revaluation account. And then let us prepare the partners capital account. So here there are some extra adjustment when compared to the previous question with regard to capital. Okay, let's see that adjustment. Here it is given in the 8th adjustment. The total capital of the firm is to be the same as before retirement. So because one of the partner A is retiring, the capital of the firm cannot be reduced. The capital has to be maintained at the same level as it was before. So what was the capital before A's retirement? 2 lakh plus 3 lakh plus 2 lakh, which comes to 7 lakh. Total capital of the firm was 7 lakh. And even in the future, they have to maintain the capital at 7 lakh itself between the remaining partners B and C, and that should be provided in the equal ratio. So B has to provide for 7 lakh into 1 by 2, which comes to 3 lakh 50,000, and C has to provide for again half of the capital, which is 3 lakh 50,000. When you are providing the working note, you have to show this one also, third adjustment with regard to capital. So these are going to be the closing capital balances. So the capital of the new firm after A's retirement. So total capital of the firm has to be maintained at 7 lakh as given, which is the capital as before. So B and C, it should be divided in the equal ratio, that is in the new profit sharing ratio. In the future they are going to share the profits and losses in the equal ratio, which means that the new profit sharing ratio is 1:1. So 7 lakh into 1 by 2, 3 lakh 50,000, and C will also same, 7 lakh into 1 by 2, that is 3 lakh 50,000. So these are going to be the closing capital balances of B and C when we prepare the partners capital account. Okay. Now when we prepare the partners capital account, as usual we need to first write what are the opening capital balances, 2 lakh, 3 lakh and 2 lakh. Then we have to check if the reserve balance is given in the question. If you see the question, on the liability side we don't find any reserve balance. Even the profit and loss account balance is not given neither on the asset side nor on the liability side. So directly we have to transfer the revaluation result here. In this case we got the revaluation profit. So we have to write by revaluation account for transferring the revaluation profit. After that we are going to show the adjustment with regard to goodwill. So the remaining partners capital account data to retiring partners capital account. By B's capital account, by C's capital account, amount is written in A's column. Then to A's capital account, amount is written in remaining partners capital account. Okay. After this, we are going to close the capital accounts of all the partners. One by one we have to close. Coming to the retiring partner, the total credit is 2,60,000. The same total is written here. It is given in the question that, 1 minute. In the ninth adjustment it is given amount due to A is to be settled 50% on retirement and the remaining 50% within 1 year. So we have to see what is the total balance. So total balance is 2,60,000, out of which 50,000 will be paid immediately on his retirement and remaining 50,000 will be paid within 1 year, which means that now we have to transfer to his loan account. So to bank account 50% of 2,60,000 comes to 1,30,000. Then to A's loan account remaining 50%, that is 1,30,000. Thereby we have closed the remaining retiring partners capital account. After this we have to close the remaining partners capital account, that is B and C. Usually in the previous question what did we do? Just like how we closed retiring partners capital account, we have closed, but in this case it cannot be done because we have calculated what are the capital balances of B and C in the new firm after A's retirement, which is going to be the closing capital balances as we calculated in the working note here, the capital adjustment. So they have to maintain capital of 3,50,000 and 3,50,000. So you have to first write two balance carried down. B will have 3,50,000, C will also have 3,50,000. So now you have to close the capital accounts of remaining partners. So here the debit side total are more, so you have to write the same total here. Then you have to take the balancing figure. The balancing figure you will get on the credit side, which represent that there is no surplus but there is shortage or deficit which has to be brought in by the remaining partner. So in B's column you are getting 30,000 as deficit balance, and in C's column you are getting 1,60,000. So these are the shortage in the capital account or deficit in the capital account which the remaining partners have to bring in. For bringing in, what is the entry we pass? Bank account data to B's capital account to C's capital account. Okay, so this is regarding the partners capital account. Then let's prepare bank account. First we need to write what? Opening bank balance, that is 1 lakh rupees. Then we have realized here, as I said initially, joint life policy will have two adjustments. The first one is you are bringing into record one more new asset, and that is credited to the revaluation account. Then it is given that joint life policy is surrendered for 80,000. Nothing but you are surrendering the policy to the insurance company. Thereby you are getting the amount. So it is as good as you are realizing one asset. So what is the entry? Bank account data to joint life policy account 80,000. Then for capital adjustment, so here A is paid 50% on his retirement. What is the entry we passed here? A's capital account data to bank account. So in the bank account we have to write by A's capital account. Then the other adjustment with regard to bank is, here for bringing in this shortage amount we have written the entry bank account data to remaining partners capital account. So here you have to write to B's capital account 30,000, to C's capital account 1,60,000. After this we are going to close the bank account to see what is the closing capital balance, closing bank balance, which comes to 2,40,000. Okay, then let us prepare the balance sheet after retirement. So all the assets and liabilities have to appear at their revalued figure, because in the first case first step we prepared the revaluation account. Land and building, all of them you show at the revalued figure, adding appreciation and depreciations. Okay, then machinery also revalued figure, stock, debtors, cash at bank is the closing balance. Then creditors we have to write back from 1 lakh rupees 20,000 should be written back. Then you have to show that 50% which is transferred to A's loan account, and the remaining partners capital account 3,50,000 and 3,50,000. When you write all these assets and liabilities, the balance sheet would tally at 9,10,000. Okay, so here I complete the second chapter, that is retirement of a partner. In the next session onwards, I'll start with the third chapter, that is admission cum retirement. So let us meet up in the next class. Thank you for watching.